All right, let's dive right into this explainer. We're unpacking the absolute high-stakes crossroads facing meta platforms today. It's August 17th, 2026, and one of the biggest tech giants on the planet is steering straight into a perfect storm that's got the financial world completely split down the middle. We're going to impartially deconstruct the raw data to figure out if Wall Street's deeply divided opinion is signaling a massive, once-in-a-decade buying opportunity or a looming structural disaster. We're looking at the hard numbers, the legal filings, and the technical charts to get to the truth of the matter. Here's our roadmap for today. We'll start with Meta at a crossroads, we'll break down their Q2 earnings, weigh the bear and bull cases, map out the technical picture, and finally, deliver the final verdict. Let's get right into it. First up, Meta at a crossroads. So right now, Meta is trading around $590. That's a pretty rough 24% drop over the past year. And look, this isn't just your standard market chop. This drop is the direct result of a massive convergence. Mind-boggling AI spending, a historic legal battle that literally just kicked off, and a technical breakdown that has Wall Street totally on edge. Moving on to Section 2, let's break down those Q2 earnings. The whiplash inside their July 2026 results is wild. It's almost like looking at two completely different companies fighting under the same ticker symbol. On one hand, the underlying business is booming. Revenues surged 28% to over $60 billion, and they're showing incredible pricing power with ad prices jumping 12%. Their Advantage Plus AI suite is humming along at a $75 billion run rate, fueled by a staggering 3.6 billion daily active people across their apps. But here's the catch. Earnings per share missed estimates. Net income actually fell 14%, and operating margins completely collapsed from 43% down to 31%. Why? Well, costs absolutely exploded by 55% to $42 billion. We're talking massive legal charges, over $1 billion in severance for 8,000 employees, and an absolute mountain of AI infrastructure spending. And this right here perfectly illustrates the real anxiety in the market. Meta's free cash flow cratered to just $784 million. That's a staggering 91% drop from their previous massive levels. Think about that for a second. When a cash printing machine suddenly stops printing cash, you better believe the market pays attention. Which brings us to Section 3, the bear case. Here's why the bears are currently driving the narrative. Meta just raised its 2026 AI capital expenditure outlook to an eye-watering $130 to $145 billion. That is nearly double its 2025 levels. This pushes their total forecast expenses for the year to a towering $165 to $169 billion. They are essentially betting the entire house on AI infrastructure, and they're doing it right now. And that massive spending has terrified some analysts. Scotiabank actually slashed their price target aggressively from 700 down to 600, pointing out that Meta is trading at 18 times 2027 earnings. Their core argument really hits the nail on the head. AI monetization remains unclear, but the spending is already a certainty. Scotiabank isn't alone here. The Q2 earnings call just didn't offer enough clarity to satisfy the street. Guggenheim cut their target to 700. Wedbush slashed theirs to 595. Heavy hitters like Morgan Stanley, Wells Fargo, and TD Cowen, they're all openly questioning the durability of Meta's free cash flow and the actual return on investment for these massive infrastructure builds. Now, layer on an unprecedented legal risk. On August 17th, an Oakland federal trial kicked off. A coalition of 29 states, led by California, Colorado, Kentucky, and New Jersey, is suing Meta over allegedly designing addictive features for minors. The maximum potential penalties? Get this, between $193 billion and $1.4 trillion. To put that completely wild number into perspective, Meta's entire market cap is around $1.5 trillion. This is not just a slap on the wrist fine. It's an existential threat to their product design. Mark Zuckerberg is expected to testify, and a loss could force massive, fundamental design changes to the core loops of Facebook and Instagram. Now, it's important to note that Meta firmly disputes these claims. They point directly to the usage limits and robust teen safety protections they've implemented. But looking at it impartially, regardless of the outcome, this trail runs through September. That ensures massive headline risk that's going to keep pressuring the stock. All right, Section 4, the bull case. Let's flip the coin. Why do some investors view this perfect storm as a generational buying opportunity? Well, Wolf Research is holding strong with an $800 price target and an outperform rating. Their argument? Trading at roughly 16 times estimated 2027 earnings makes this a historically cheap entry point. As they put it, you're getting a higher quality asset trading at a material discount to the broader S&P 500. The crucial point for the bulls is that while the bears say AI monetization is unclear, the bulls see AI paying off today. Mark Zuckerberg stated on the call that AI is actively accelerating their core business. We aren't just talking about fun little chatbots here. We're seeing tangible metrics, an 8.3% increase in ad clicks and a 15.7% uplift in Facebook conversions. 9 million small businesses are actively adopting their AI creative tools. Plus, with new Muse models and a tiered Meta One subscription, they're even positioning themselves as a neo-cloud provider to sell off excess compute. This is active monetization. At its heart, that underlying ad engine is firing flawlessly. Meta remains the fastest-growing ad business on a dollar basis reporting today. And perhaps the most exciting nugget for the bulls, WhatsApp paid messaging and subscriptions just crossed the $1 billion mark in other revenue for the very first time. They are finally actually monetizing that massive WhatsApp user base. Let's move to Section 5, the technical picture. Let's look at the charts to see how this builds into actionable levels. With the current price hovering right around 590, the technicals are an absolute battleground. Support is sitting between 580 and 600. Holding that 580 level is absolutely critical. If it breaks, the risk zone drops quickly down to the 545 to 560 range. Now, breaking below the 200-day moving average, which is a key health indicator sitting around 605, is undeniably a bearish signal. That's overhead resistance now. But momentum indicators like the RSI suggest the stock is heavily oversold. Honestly, seeing a highly profitable mega-cap stock trading below its long-term trend line is exactly the kind of setup contrarian analysts look for to build long-term confidence. Finally, Section 6, the final verdict. So where does that leave us in this high-stakes tug-of-war? It really comes down to timeline and risk tolerance. For the bull, you're buying a globally dominant ad platform at a historic discount. The AI is bearing fruit, user engagement is massive, and if those AI investments fully monetize, there's a clear mathematical upside to the 750 or 800 range. But for the bear, the reality right now is exploding spending, collapsing free cash flow, and an unprecedented legal trial that threatens the core product. If those headwinds persist, the downside quickly drops to 545 or worse. The fundamentals for massive upside are there, but the immediate financial and legal headwinds over the next few months are incredibly fierce. So I encourage you to weigh these facts and monitor these metrics closely. Watch the headlines coming out of that trial through September. Keep an eagle eye out for any new announcements on AI monetization milestones, and technically, watch to see if they can reclaim that crucial 200-day moving average. Once you factor all of this in, you've got to decide for yourself. Looking at the raw data, is Meta currently a value trap, or are you prepared to place a generational bet on the future of AI infrastructure? Thanks for joining me on this explainer. Keep learning, stay focused, and I'll catch you next time.